the bank reconciliation. Usually this will be the first item that your accountant will want to see when that accountant shows up to do your books, so you have to know how to do a bank reconciliation. Why is it important? Largely because sometimes mistakes are made and they're not always made by you, sometimes they're made by the bank. For my construction company, I deposited a check for $50,000 from a customer, and I immediately went out and I wrote checks to pay off, you know, all my subcontractors. But I was working with a small bank. These checks started bouncing, and so rather than just, you know, do nothing, the bank called me up and said, "Hey, what's up here?" And I said, they said I was bouncing checks. Well, it turned out they had miskeyed that $50,000 deposit and had put it in as $5,000 instead of $50,000. So that mistake was quickly repaired. I went up to the bank with my deposit slip and they said, "Oh yeah." Another time on my bank reconciliation, on the statement from the bank, I found that a check had been paid out of my account for another company's bills. And the companies had similar names, and again, it was a clerical error, but at the bank. So a phone call put the $800 back in my account. The more usual errors are usually with the company books, where numbers are transposed, or you know, just forget to put something in. So anyway, sometimes mistakes are made, so you reconcile your books with your bank statement each month. There will be items on the bank statement that your company books may not know about. There might be a monthly service charge. You could have ordered checks through the bank and those were deducted. Maybe you have a setup so that the bank pays directly utilities or other bills. So you have electronic funds transfers, EFTs, where the bank directly pays your bills. Some customer could have given you a check that bounced, so you have non-sufficient funds charges, NSF, there's interest revenue on the account, and maybe you have the bank collecting notes receivable for you directly, where the person that owes you money just pays it directly to the bank. So those are the things that on the bank statement that the company books need to be informed about, because they don't know until the bank statement comes. And so then there's also things that the bank doesn't know about yet, and these are things that are on the checkbook, but the bank may not know about. And these are your checks outstanding. In other words, we've written checks, and the company has written checks, but they haven't cleared the bank yet. Deposits in transit, we've entered them in the company books, but they have not made it to the bank yet. They haven't cleared through the banking system. So it's all of these things that get reconciled on a bank statement. So what gets reconciled? Well, maybe you've been in a relationship where there were some serious issues that need to be resolved, shall we say, and unless it's a situation of irreconcilable differences, each party has to make some adjustments, and some reconciliation is reached. So that's kind of like a bank reconciliation. You've got two parties involved. You've got the bank. You've got the company books. You have to. You're usually not adjusting things on. You're not adjusting things on the bank statement, but you're taking information from that and using it to make adjustments to your books. Then after you've made the adjustments, then the two amounts should reconcile, and you can say that the bank balance is equal to the balance per books. Okay, so I have a quick and, not quick, but I have an easier way of doing bank reconciliations in terms of format than Wiley. I have to do probably 5 or 6 bank reconciliations every single month, and I've had to do that for years, and it takes me probably 5 tries to get one right on Wiley Plus, doing it with all of their subtotals and everything. So this format that I have here gives you the thought process behind the bank reconciliation. You can put this in any format that works for you, but if you know the basic thought process, you can put it in a format you like, you can put it in a format where you work, their format, or you can maybe even do Wiley Plus with it. So how does it work? you start off with you got two sides to it. You've got the bank side and the book side. So this is you start off with the balance per bank statement. That's the ending balance. You add the deposits in transit. These are the deposits that are on the company books, but they have not cleared through the bank yet. They're usually the ones at the end of the month, maybe on the 29th of the month, and the bank statement is dated the 29th, and they just didn't make the cutoff. You're deducting checks outstanding, and you would list the check numbers and all of that here. The checks outstanding, we've written them, but maybe they haven't made it to the bank yet. Maybe the plumber, I give the check to the plumber, and he gets in the truck with it and drops his coffee, and everything goes flying, and the check ends up under the seat. Well, it could be a couple of months before that one clears, you know. Okay, so when you add the deposits in transit, you deduct the checks outstanding. Chances are this adjusted balance per bank is going to be what you're aiming for, unless there's been bank errors. And in a problem on the homework, they would tell you if there'd been a bank error. And I think there probably are. Okay, so basically you're adding the deposits in transit, deduct the checks outstanding. And this adjusted balance is where you're looking to get. Okay, then you come to the book side. You start out with your ending balance per month, the company books. You're going to add anything that you find on the bank statement that the company books don't know about. So collection of notes receivable, collection of the interest, all of that. And then you're going to deduct any service charges or check order charges, any direct payments the bank has made from your account, and non-sufficient funds, the bounced checks, okay? And so when you start with the balance per books, you add these things, deduct all that, you get the adjusted balance. Your goal in life is to have this equal the adjusted balance per bank, okay? So, all right, what else here? Oh, then if the amounts don't come out right, then there's usually, there's been some errors made, generally on the company books. And so at that point, you have to compare the amount of checks listed, the amounts of the checks listed on the bank statement with the amounts in on the company books. And you'll find a usual error would be that a check was made out for $508.47, but it was on the books at $508.74 or something like that. And so you have to make those adjustments, and those will either be deductions or additions to the book side of the bank reconciliation, depending on what needs to happen. You do the same thing with the deposits. Okay, if the balances still aren't the same after you do that, then you look at the bank for bank errors. And bank errors are not adjusted on the company books because they're not your errors. Those are the bank errors, and you call up the bank and tell them about them, and they have to fix their books. Okay, but that's only part of it. Once you get the bank reconciliation done, then you have to do the journal entries that tell the books, tell each individual ledger account what has happened. So there's going to be a journal entry that describes everything that ends up listed here. Okay, so I think the easiest way is for me to work through a problem, and that's what I'll do in the next video.